Cadmium Company is a nice example of how dividend policy can be tested. Let's start with reading the requirement to know what to look for when we read the scenario. Calculate the forecast dividend capacity of Cadmium for 2016. So, forecast dividend capacity means that we have to calculate free cash flow to equity. Discuss the viability and financial impacts of Cadmium Company seeking to maintain its current dividend policy, supporting your answers with relevant calculations. And we have a note that 5 marks are available for calculations, and if we have 10 marks in total, this means that we have 5 marks for thoughts. So there should be 5 thoughts at least. The viability means that the company can continue with that. Financial impacts means how this will reflect on what we have in financial statement. And seeking to maintain its current dividend policy, well, we need to see what the dividend policy is, because it can be either constant dividend or growth or, for example, payout ratio. So we will see that in the scenario. Discuss the governance and ethical issues associated with Cadmium Company's dividend and directors' remuneration policies. We have 5 marks here, and we have 2 policies, dividend and remuneration policy. And we need to talk about governance, which means how the company is managed and controlled, and also ethical issues. And when we talk about ethical issues, please do not say it's unethical or it is bad. You need to actually list the issues which you are given in your theory. So, for example, you can talk about integrity or objectivity, or, for example, professional competence and due care, and so on. So you need to state the exact issue. And now going back to the scenario. Cadmium Company is a large company in the support services sector. Cadmium Company's most recent annual report for the year ended 31st December 2015 acknowledged challenges for the company, including financing the major investment program required to meet its clients' increasing expectations. So the company has a challenge to finance the investment program. And we need to spot these things because we need to show the examiner that we can read the question and that we can look at it with skepticism and also with some commercial background, with commercial knowledge. Cadmium Company also faced upward pressure on employment costs, fueled by a fair wage campaign which adversely compared wage rises in the support services sector with increases in dividends and directors' remuneration and a consequent government inquiry into low pay in the sector. So these are governance and ethical issues about the pay. Cadmium Company's board, however, was confident that the company would be able to renew a number of large contracts which were coming up for review. So the board is confident, and this raises an issue about its governance, actually, how competent the board is, because they see that there are problems, but they are still very sure. The report stressed the strength of Cadmium Company's senior management team as a vital success factor. Directors' remuneration packages thus reflected the need to retain its directors in a competitive labor market at senior level. So they think that it's very important that they keep employing those directors, and therefore they want to pay them adequate amount of money, and we will need to challenge that. In the stakeholder engagement section of its annual report, Cadmium Company highlighted that it had fulfilled its aim of guaranteeing investors a consistent rise in dividends, and its board was confident that Cadmium Company would be able to maintain the recent rate of a dividend increase. So look, the company has annual report, and when it writes something there, this means that it creates expectations. So it shouldn't write anything there unless it's absolutely certain. So the company said that it was very confident that the Cadmium Company would be able to maintain the rate of dividend increase. So if that there is going to be a problem, that this creates issue over how honest the company is, the directors are. Or maybe they just do not know, they just do not have enough professional competence. And that's what was asked in the question C. Dividend policy. At Cadnam Company's last annual general meeting, there were no questions about the level of profits, dividends or directors' remuneration. However, a recent investment analyst's report on the support services sector highlighted Cadnam Company as a company which might have problems in the next few years. The report suggested that Cadnam Company's investment and dividend policies could not both be maintained, so either one or another, or maybe not one, not another. It highlighted one of Cadnam Company's principal competitors, Homestay Company, as a company whose policies it believed would sustain long-term growth. Okay, so they think that that company is long-term success. It highlighted directors' remuneration as an area where Homestay Company policies were more likely to encourage long-term value creation and share price increases than Cadnam Company's policies. So long-term value creation and share price increases are usually about such types of remuneration as, for example, share options or long-term bonuses. Cadnam Company's board is currently considering the comments made by the investment analysts and also assessing what the dividend for 2016 should be. That's the financial information we are going to use to provide our calculations. And here we have profit after tax, dividends, investment in additional assets, share price, gearing. And that goes for 2 companies. And also we have information about average sector data. Average gearing in the support services since 2011 has been stable at around 34%. There have been no changes in the issued share capital of Cadnam Company and Homestay Company since 2011. So this means that everything that was financed through debt. Directors' remuneration. Let's have a look. So we have average salary executive director, and they're the same. Performance bonuses, and they're slightly higher for Homestay. We have loyalty bonus, and there is loyalty bonus for Cadnam, but no loyalty bonus for Homestay. And if we talk about loyalty bonus, they do not create long-term view for the company. They are just bonuses like normal bonuses. And share options for Homestay Company, however, we have no information on how big it is relating to the average salary. So we do not know how desirable this remuneration part is. So the forecast says that Cadnam Company's pre-tax operating profit for 2016 will be 2678, an increase of 3% compared with previous year, and operating profit margin will be 2%, and that was the same as for 2015. The tax rate will be 30%. Average debt 10 to 250, and predicted year-end gearing will be 41.3%. The average pre-tax interest rate on the debt will be 8%. The investment required to keep the non-current asset base at its present productive capacity in 2016, and there will be 2430 million, which has been included in the calculation of operating profit as depreciation. Okay, so this means that operating profit that we have, which is usually profit and loss item, so it's not cash item. For us, it's more or less is about cash, because the non-cash expense, depreciation, is actually the same as the payment from the company for keeping up with that non-current asset base. Investment required in additional assets in 2016 will be $0.25 for every $1 increase in revenue. So we will have to calculate the increase in revenue, and we can do that because we have operating profit and we have operating profit margin, which will help us to find revenue. Okay? So that looks like we can start with the first question. And when you start with a question, please read it again to make sure that you are answering the specific question that is asked. we need to calculate forecast dividend capacity, which means to calculate free cash flow for equity. And when we're asked to calculate, this means that we need to provide only calculations, no words, no talking. If you were asked to evaluate or discuss, then you would need to calculate and then comment on that. Let's say positive, negative, good, bad, high, low, and so on. But in here, only calculate. So we needed to get our operating profit cash flows, see. Then we will have to subtract finance cost, and we have the value of the debt, and we have the interest, and also we will need to subtract the tax rate. And let me just highlight that in different color. So that's our figures that we need. We need operating profit, we need tax, and we need finance cost. And also we will need the expense the company is going to make on buying some new assets. And we are told that it's $0.25 for every $1 increase in revenue. Okay, so let's calculate. We start with operating profit, and it's 26.78 million. Then we need to deduct finance cost, which is 10,250 multiplied by 8%. That's 820, and of course that's a negative amount. Then we deduct tax. To deduct tax, we need to calculate the subtotal, so it's going to be 1,858 million, and we deduct tax, so it's what we have calculated above, multiplied by the tax rate of 30%, which was given to us, and that is 557 million. Okay, and after that we need to deduct investment in asset. So less investment in assets. And let's see. The investment is calculated from the increase in revenue. And we know that we have operating profit over 26.78 and profit margin will be 2%. So we have to take that amount and divide it by 2% to find revenue. However, this is the revenue for 2016. And to calculate the increase in revenue, we need to see the increase in operating profit, and it's 3%, so we multiply it by 3 and divide by 103. And that will be the increase in revenue, and we need to multiply that by $0.25, and that's what we are going to get. That is 975 million, and of course that's with a negative sign. And let's see how much we have left for our dividends. It's 326 million. And that's it, because we needed only to calculate. And now going to part B. So in part B, first we do the calculations, and then we talk about viability and then financial impact of current dividend policy. So let's see what we can calculate here. And we do need to do calculations. We cannot just list, for example, cherry. So it would be logical to find dividend growth. So I have dividend, and if I divide, for example, 840 by 765, I will take dividend growth. So 840 divided by 765 and so on. Also, we can find dividend payout ratio. So dividend payout, and it's going to be for 2012 765 divided by 1380. Then we can find, for example, how much money is left after paying dividends. So there are actually two ways you can do that. You can either take profit after tax and subtract dividends, and in this way you will calculate whatever is left to increase the company, so money for investment in additional assets, as well as what is left. However, you can also calculate that as profit after tax less dividend less investment to see whether there is enough money to provide both dividend policy and the investment increase policy, because that's what we had in our scenario. See, there were both can be maintained. The word was both, so we can calculate that by actually looking at numbers and trying to see whether it's positive or not. Then we have share price, so it would be logical to use all the information that is given to us. Therefore, it would be logical to find share price increase. Share price increase. So we already have 1, 2, 3, oops, sorry for that, 4 ratios. However, as we are awarded 5 marks, then we need 5. And look, as we find dividend growth, it would be nice to find profit growth, profit after tax growth as well, because it will give us the idea whether the dividend growth is sustainable, because dividend growth should not ideally be higher than profit after tax growth. Okay, so we are not going to calculate that. Instead, we can use what the examiner has already provided for you in your model answers. I will just quickly comment on how those values were calculated. So profit after tax growth, it's a profit after tax for current year divided by profit after tax of the previous year. Dividend payout ratio is dividend paid in current year divided by profit after tax for this year, for the same year. Growth in dividend means dividend for current year divided by dividend in previous year. Then we have calculated here residual profit, and you actually have the formula here. Profit after tax less dividend less new investment, and growth in share price, which is share price in current year divided by share price in the previous year. So we are going to be awarded 5 marks for these calculations. However, we need to comment, and we get up to 5 marks on commenting that. So as for viability, we need to compare the growth in dividend with the growth in profit after tax. Well, let's see. The growth in dividends, the mean growth in dividend, and that average rate is taken as summing up the 3 figures we have and dividing that by 3. And so it's 10.1. And it's much higher than HOMSI provides. However, when we look at the growth in profit after tax, we will see that it's much less. So this means that such growth in dividends will not be repeated for long enough. So as dividend growth is smaller than profit after tax growth, then not sustainable. We can also comment on the comment of analysts that both policy on dividend payout and investment in assets cannot be sustained. And yes, we can see that from here. Look, because after our company has made all of that, it is left with negative cash balance. So negative cash flow, so it's -3 or 4. So as residual profit is less than 0, the company cannot do both. So that dividend policy is not likely to be sustained. Also, Let us see what else we can say about the sustainable growth. Well, we have a dividend payout ratio, and we see that it's much higher than that one of HOMC, and this means that the company will be less competitive because it will just have less funds to invest in positive NPV project. So as a payout ratio is higher than HOMC, less competitive because fewer positive NPV projects can be taken. So this is about financial viability. As for financial impact, let us see. So as that growth in dividend is much smaller than growth in profit, then company will have to finance it from somewhere. So impact on financial finance is going to be that loans will increase and gearing will increase as well, so it will become worse. So financial impact, let me just scratch it here, financial impact, loans to pay dividends, and therefore gearing increases, getting worse. Also, we see that share price is falling. Yeah, we haven't commented anything on share price. It's not falling, but it's growing by a much smaller rate, and the growth in share price actually falls, whereas growth in share price for HOMC increases. And we can see that the investors prefer HOMC before Cadnam, even though Cadnam provides higher dividend growth. So Cadnam provides 10.1 and HOMC only 5.3. However, HOMC provides higher growth in profit after tax. So this means that as investors prefer growth in profit after tax to the growth in dividends, then this means that share price is going to decrease even more. And also, let me see. So we can see that the residual profit is negative in 2015. So this means that it is likely that our company will just not have enough money to finance all the project it wants. Therefore, the growth in revenue will be smaller than growth in revenue for other companies, for HOMC in our case. Well, and that's it, because we commented 3 thoughts on viability, 3 thoughts on financial impact, and as we have something like 5 marks for comments, then that's enough. And it's very important to limit yourself so that you do not overspend your time on this question, and so that you are able to attempt all 3 questions in your exam.
Now, question C. We need to discuss the governance and ethical issues. So these are 2 separate questions, therefore we are going to write them separately. And we need to talk about conflicts.
So we can say, as for governance issue for dividend policy, the dividend payout ratio increases and the company doesn't have enough residual cash to go with its investment in asset policy, and this means that it is likely that the company just does not measure how much dividend it can pay. So optimal dividend level not assessed, and that's governance issue. As for ethical issues relating to the dividend, we have here that the annual report suggested that investment and dividend policy cannot be maintained, and we may say that the company is just lacking, the directors of the company are just lacking professional competence. So professional competence, and we need to say why, because they are not assessing dividend payout right correctly. As for remuneration and as for governance issue, we see that government is looking into low pay in the sector. So this means that the company fails to provide adequate pay, and therefore it means that the company has poor policies relating to assessing whether the wages they offer their employees are adequate and are in line with government expectations. Adequate. And as for ethical issues, we can see, yes, indeed, the dividend increase, the director remuneration is higher than its of HOMSI. However, the money that employees get are much smaller than the government expects. So we say that our directors are not acting with integrity, offering too low pay. And also, our directors in the report say that they can make this remuneration scheme. However, they likely not be able to support it in long term. So this means they are acting not with integrity because in fact they are lying. So that's about dividends and remuneration. However, we also need to make sure that we identified and exploited all the hints that the examiner made. And look, we have the full list of information about directors' remuneration that we haven't used yet. And from this piece of scenario, we can see that HOMSI has a share option scheme, so their directors are encouraged to take long-term view, whereas Cadnam companies' directors not. So this is an issue relating to the governance. So that's poor benefit scheme, which does not favor long-term view. So, no remuneration to promote long-term view. Also, we can say that the bonus is 35%, the combined bonus of the salary, whereas for HOMSI it's only 30%. So it might as well be that Cadnam pays more to its directors. However, the results of the company are not as promising as HOMSI's. So it may as well be that KPIs and performance assessment is not done in a proper way. So overpays. Poor HR management. And that's it. Just please make sure that you limit your thought. Because see, you have 5 marks only. So this means that you are to provide only 5 issues, not 10 of them. And I'm pretty sure that you can identify much more issues, but we need to make sure that we have enough time for the last question we are going to attempt. And now let me just comment on professional marks that we have here. In here, we do not have professional mark for communication because we usually are awarded them when we prepare a report. However, we have marks for analysis and evaluation, and these marks you pretty much get automatically by taking the numbers and providing calculations. So it's really hard not to get them. As for skepticism, you would get those marks for assessing directors' remuneration scheme and saying, okay, well, maybe we are overpaying them and they do not favor long-term view and so on. So this is why it is important to actually take all the information from the scenario and the information which looks most important, because even if you scored marks on some other thoughts in part C, you wouldn't get professional marks if you wouldn't talk about this piece of information relating to director remuneration. And last but not the least, commercial knowledge. Well, that's also about you talking about the part C, about dividend and how company can support dividend payment if profit after tax does not grow in such a rate or not. So you are given your professional marks for your proper justification, and if you do justify your thoughts in a proper way, then it's likely that professional marks will be awarded more or less automatically.